All right, today we're breaking down a real market mystery. The huge, dramatic collapse of silver that seemed to come out of absolutely nowhere. But did it really? We're going to look at the clues that were hiding in plain sight and, maybe more importantly, what this spectacular crash could mean for the rest of the market. Let's dive in.
40%. That is a massive number. That's how much silver plunged in a single day. Just imagine watching something you own lose almost half its value between your morning coffee and your afternoon meeting. This was one of the worst drops for silver in over a century. A move that big isn't just a bad day at the office. It's a historic event, and it begs for an explanation.
So what was this? Was it just some random, unpredictable market fluke, a total freak accident? Or, if you knew where to look, were the warning signs flashing all along? That's the big question we're going to tackle here. We're going to dig into the evidence and see if this whole catastrophe could have been spotted ahead of time.
Okay, so let's set the scene. It was a recent Friday in January, and the silver market didn't just drop, it basically fell off a cliff. Now sure, a couple things fed into it, a stronger US dollar, some chatter from the Federal Reserve, but those were just the sparks. The real story, the pressure that had been building up, well, that was brewing in the charts for weeks.
And this is where it gets really interesting. Because if you were looking at the technicals, the price action itself was practically screaming a warning. Turns out, there were several classic signs of what's known as a blow-off top. You know, that final insane surge in price right before an equally insane collapse.
So what were these clues? Well, there were four huge ones. First, silver's price was stretched so far from its average, it was ridiculous. We're talking over 100% above its long-term trend. Think of it like a rubber band pulled way, way too far. It had to snap back. Second, we saw these things called exhaustion gaps. Third, trading volume went through the roof. And finally, the price hit a major technical target and just slammed into reverse. Let's talk about that exhaustion gap for a second. It sounds complicated, but the idea is actually pretty simple. Imagine a sprinter at the end of a race. It's that final, desperate burst of speed they give right before they totally collapse over the finish line. That's an exhaustion gap. It's the last frantic wave of buying from people who are terrified of missing out right before the sellers finally take over. And get this, silver showed 4 of these warning signs before it crashed.
And then there was the volume. Oh my gosh, the volume. Trading in silver ETFs just absolutely exploded. And this is a textbook example of market psychology. When a trade gets that popular, when everyone is talking about it and piling in, it's often a sign that irrational exuberance has taken the wheel. Everyone's convinced it can only go up. And you know what? Historically, that is almost always the point of maximum danger.
You know, the legendary trader Jesse Livermore said it best with this quote. The technology changes, the stocks change, sure. But the core human emotions that drive markets, good old fear and greed, they are timeless. This silver crash wasn't some new, crazy thing. It was a story as old as Wall Street itself, just playing out with a new cast of characters.
And that's the thing. We have seen this movie before. To really get how serious this event was, we have to look back in time. This is not the first time silver has had a massive blow-off top, followed by a devastating crash, and history gives us some seriously spooky parallels.
You can really point to 2 huge historical examples. The first was way back in 1980, when the Hunt brothers tried to corner the silver market, and it led to this epic boom and bust. The second was in 2011, right at the peak of a massive commodity bubble. And in both of those cases, the pattern was almost identical to what we just saw. And here is why that history is so incredibly important. Just look at how long it took to recover. After that 1980 peak, it took 30 years, 3 decades, for silver to hit that price again. After 2011, it took 13 years. So we're not talking about a quick dip and recovery here. These blow-off tops can mark the high point for an entire generation of investors.
Okay, so right about now you might be thinking, this is all pretty interesting, but I don't trade silver, so why should I care? And that is the most important question. Because the answer is, this crash might not just be about silver, it could be a warning shot for the entire stock market.
See, in the past, people mostly thought of silver as just a precious metal, something to hedge against inflation. But today, its role has totally changed. It is a critical industrial metal for the fastest growing parts of our economy. It's in electric vehicles, it's in semiconductors, and this is a big one. It's essential for AI data centers. So when industrial demand for silver is booming, it means the economy is strong. When it collapses, well, that can be a signal that things are about to slow down.
And we don't even have to guess. We have a very recent, very powerful example of this connection. Let's rewind to 2011. In the 5 days, just 5 days, right after silver hit its peak, the S&P 500 plunged 11%, an 11% drop in 1 week. This shows that a major top in silver can come right before some serious weakness in the stock market. So yeah, the connection, it's definitely there.
Which brings us right to our final, lingering question. We've seen the clues, right? The price stretched way too far, the exhaustion gaps, the crazy volume. We've looked at the history. And now, knowing how deeply silver is tied into our modern AI-driven economy, was this spectacular collapse just a sideshow? Or was it the first domino to fall? Is silver acting as the canary in the coal mine, warning us all of broader trouble ahead? History tells us that's a question we all should probably be asking.